everyone, and welcome back to the channel. Today, we're diving deep into a topic that's crucial for anyone in finance, business, or compliance: trade-based money laundering, or TBML, and the red flags related to such laundering activities. This isn't just some abstract concept. It's a massive global issue where criminals disguise the proceeds of crime through legitimate trade transactions. Think of it as hiding dirty money in plain sight, using goods and services as a cover. So, how do you spot it? That's the million-dollar question, and today we're going to break down the key risk indicators based on extensive research from organizations like the Financial Action Task Force, or FATF. These clues can help banks, businesses, and even government agencies flag suspicious activity before it's too late. It's important to remember. A single red flag doesn't automatically mean money laundering, but a combination of them. That's when you need to start paying very close attention, ready to become a T-bill detective. Let's get started. First up, let's talk about structural indicators. These are the red flags you can spot just by looking at the company itself, its setup, and its background. Imagine you're vetting a new trading partner. One of the first things to look out for is an unusually complex corporate structure. Are they using a web of shell companies? Are these companies registered in jurisdictions known for weak anti-money laundering controls? That's a classic warning sign. It's like a magician using smoke and mirrors. The complexity is designed to confuse and obscure who is really pulling the strings. Another big one is the company's address. If a major international trading firm is registered to a post office box, a high-density apartment building, or a mass registration address with no specific office unit, you have to ask why. Does their physical footprint match their business claims? A company supposedly trading tons of steel but operating out of a residential basement with no warehouse is a huge red flag. It just doesn't add up. And in today's digital age, what about their online presence? A legitimate business will have a professional, detailed website. If their site is just generic, boilerplate text copied from somewhere else, or if it shows they have no real clue about the industry they claim to be in, be suspicious. Also, look at their basic business activities. Are there regular payroll transactions? Payments for rent, utilities, or taxes? A company that claims to have 50 employees but has no record of paying them is likely not what it seems. We also need to look at the people involved. Are the owners or managers just nominees, people with no real experience who are just a front for the actual beneficial owners? If they can't answer basic questions about their own transactions, that's a problem. Do a quick search for negative news. If the company or its leaders have a history of fraud, tax evasion, or other criminal investigations, that's a clear warning. Combine this with a suspiciously small number of staff for a high-volume business, or a company name that's trying to mimic a well-known corporation, and the picture starts to get very concerning. Unexplained periods of inactivity followed by sudden bursts of trading can also be a signal that something isn't right. Now, let's move on to the second category, trade activity indicators. This is where we look at what the company is actually doing the buying and selling. The most obvious indicator is when the trade activity is completely inconsistent with the company's stated business. For example, if a company that sells used cars suddenly starts exporting massive quantities of high-end textiles, or a precious metals dealer begins importing frozen seafood, that's bizarre. There's no logical connection. Another sign is overly complex deals. Why would a simple transaction involve numerous third-party intermediaries, especially if those intermediaries are in totally unrelated lines of business? It's like taking a winding, scenic route through 5 different towns just to get to your next-door neighbor's house. It's inefficient and makes no commercial sense, unless the goal is to muddy the waters. The same goes for shipping routes. If goods are being sent on a world tour through several countries for no apparent economic reason, it could be a way to layer the transaction and make it harder to trace. Also, pay attention to how they use financial products. Are they using letters of credit for unusually long periods, or constantly extending them without a good reason? Are they mixing and matching different trade finance products in a way that just seems unnecessarily complicated? This could be a deliberate attempt to abuse the financial system. And what about profitability? Business is about making money. So if a company consistently shows unreasonably low profit margins or even losses on its deals, you have to question their motive. Why would anyone repeatedly import goods at or above the local retail price, only to sell them for the same price or even less? That's not a business. That's a money-losing operation, unless, of course, the real goal isn't profit from the trade, but moving illicit funds. This is especially suspicious if the company is suddenly able to make huge purchases financed by mysterious cash influxes or third-party transfers. A brand new company suddenly trading in high volumes in a sector with high barriers to entry is another major red flag. The third area of focus is the paperwork and the goods themselves. The documents, contracts, invoices, shipping forms are the paper trail of the trade, and they can hold a lot of clues. Look for inconsistencies. Does the name of the exporter on the invoice match the name of the entity receiving the payment? Do the prices on the contract align with the prices on the invoice? Are there discrepancies in the quantity, quality, or description of the goods between different documents? Any mismatch is a cause for concern. The pricing itself is another indicator. If the fees or prices seem way out of line with the fair market value for those goods, you have to ask why. Is a simple commodity being sold for 10 times its normal price, or maybe for a fraction of its value? This is a classic technique called over and under invoicing, used to shift value across borders. Vague descriptions are also a problem. If an invoice for $1 million shipment just says goods or products without any specifics, that's highly suspicious. Legitimate trade requires clear, detailed descriptions for customs and logistics. Also, be on the lookout for fake or altered documents. Are the supporting documents missing? Do they look like counterfeits? Are they constantly being amended or resubmitted after being rejected? That's a sign someone is trying to force a fraudulent transaction through the system. And don't be fooled by simplicity either. A multi-million-dollar international deal supported by a one-page sample contract downloaded from the internet is just as suspicious as an overly complex one. Finally, we have the fourth set of indicators: account and transaction activity. This is where we follow the money. A huge red flag is a last-minute change to the payment arrangements. The deal is set, the goods are in transit, and suddenly the seller asks you to redirect the payment to a completely unknown company or person, often in a different country. This is a classic move to break the financial trail. Monitor the account activity itself. Does the volume or value of transactions suddenly spike and become inconsistent with the client's known business profile? Look for pay-through or transit accounts. These are accounts where large sums of money come in, are rapidly moved around, and then transferred out, leaving a tiny balance at the end of the day. The money doesn't rest, it's just passing through on its way to somewhere else. For instance, you might see frequent cash deposits that are immediately wired to entities in free trade zones or offshore jurisdictions, or you might see incoming wires being split up and sent to multiple, unrelated accounts. Another telltale sign is when the payment for the goods is made by a third party that has no obvious connection to the transaction. The consignee is Company A, but the payment comes from Company B, a shell company with no role in the trade. Why? It's likely an attempt to distance the dirty money from the actual goods. Also, keep an eye out for structuring. This is when a company consistently makes cash deposits or transactions that are just below the mandatory reporting thresholds to avoid automatic scrutiny, and be wary of accounts that suddenly become hyperactive with high volume trading, only to go completely dormant after a short period. This fire and forget pattern is common in money laundering schemes. Lastly, watch for payments in large, round numbers in sectors where that's unusual, or payments that are rooted in a circle leaving one country only to be funneled back after passing through several others. So there you have it, a guide to the key risk indicators of trade-based money laundering, broken down into four main areas: the structure of the company, its trade activity, the documents, and its financial transactions. By learning to spot these red flags, whether you're in banking, logistics, or running your own business, you can play a vital role in protecting the integrity of our global financial system. Remember, vigilance is our best defense against those who seek to exploit it. Thank you so much for watching. If you found this information valuable, please hit that like button, share this video with your colleagues, and don't forget to subscribe for more deep dives into the world of financial crime prevention. Stay safe and stay informed. See you in the next video to know more.